some of these questions to Sandip Agarwal of Sowilo. Sandip, great having you. Thanks for joining in. And Sandip, I wonder if you expect anything remarkable from any of the three IT companies that come out with numbers today in terms of their commentary or the results, which could have a bearing on the IT space at large over the next few days.
Yeah, hi, good morning, and thanks for having me on the show. So, I think that the challenge is that, the business has become very, very mature. So these companies are doing a great job, but unfortunately, in an environment where, you have just come out of the digital disruption a couple of years back and now stabilized, and now the new AI disruption has happened, which for the first time in last 3 decades, we have seen that there is an impact on effort. Still now, all the disruptions were transition from one technology to another. So you have to just retrain your workforce, which may take 4 to 6 quarters, and you can redeploy and your revenue will see a big jump. Unfortunately, this time the disruption which has happened is an effort cut, which is 30% effort cut. And our strength as a country and the industry was always providing effort at a very reasonable cost and very well-trained resources. Now that business fundamental itself is in question, and because of that, you are seeing all the challenges despite these companies being the best in the world in terms of execution. And let me tell you, our market share will be like more than 90% if you exclude the BPO portion from numerator and denominator. So what better you can expect from an industry which is already at more than 90% market share, and they are doing superb, everything right. And we are growing much higher than the sector growth. But, there is a reality that, efforts will be seeing 30% cut. And because of that, despite every good effort, these companies will not be able to post meaningful growth, not only 1 or 2 years, I think structurally for maybe 3 to 5 years at least.
Okay. And Sandip, that is a reiteration of what you spoke the last time as well. The fact that unfortunately the growth in the sector is anemic. But then you have a situation, for example, in trade yesterday were Persistent on account of a surprise on the earnings, saw a reward in the form of a 7% uptick on the share price. So there are pockets, or there are a few outliers. What, according to you, would those outliers be?
So, outliers will be from the technology segments, basically. So whoever is there in ER&D and who is working with high-tech, they will definitely grow at double the rate of the IT services space. So, for instance, if the large caps are growing at, let's say, 5-6%, which is also optimistic case scenario, then this good quality mid cap, which are into, high-tech and ER&D, they will grow at 11-12%, 13%. So that is a reality, and that will continue for next 5-7 years, because ER&D as a space has very low penetration of of outsourcing, and that penetration is picking up very sharply. And particularly after the Ukraine-Russia war, we have seen massive demand for outsourcing from India. That space was earlier massively serviced by EPAM and others. So there is a massive tailwind there. But again, remember that tailwind, one, ER&D is a much smaller overall space versus the IT services. And secondly, that is also growing fast now for 3-4 years. And that's the reason you have seen that all these stocks like Persistent, KPI, and many of them, they have moved up 8-10x in very short span of time. So I think even there, you have to be look at more rationally, because the PEG ratios across the board, large and mid cap, is very, very high. People are just seeing the underperformance of the sector for last 2-3 years and zero return and all that. They are not seeing that the underlying, which is the growth, has also fallen meaningfully, and because of that, the PEG ratios still are very high compared to what were earlier, although the stocks have not made any return or they have given negative return. So I think the right way to look at IT sector next 3 to 5 years will be what PEG ratio you are assigning, rather than only looking at what the stock has done in last 2-3 years.
Completely fair. So then, therefore, just to close out this conversation, especially in the context of yesterday's move in Persistent, would you say that there are any buys, or would you wait for better opportunities down the road? I would assume, based on your previous answer, that the only space that you see great potential on the upside, at least in terms of earnings growth, is that ER&D space. But as you've already pointed out, the valuations might just be a little stretched for your liking. What is your call? What do you like right now, and would you be buying at all?
So, honestly, 10-11 months back, or almost 12 months back, we have exited all our IT services positions. Most of them, maybe small, minuscule position, 1 or 2 will be there. But we have massively shifted in last 2-3 years, a lot of money to platforms, and that call has done well. And we are very big fan of platforms, because I firmly believe that our strength is not the enterprise IT or the operating systems and all, because there needs 300, 400, 500 billion dollar of investment over a period of time to achieve anything. And our strength is the consumer tech, where we have done phenomenally well. And I think all these consumer tech platforms, whether it is Urban Company, it is Eternal and all, they will do very, very good. And these are our big tech. That is my big call. I think that this companies in next 10 years will give you 300 to 500 billion dollar market cap, each of them, because that is our strength. That is the problem which they are solving. Remember, US big techs are solving problem because of capex. So they are using the capital in a very efficient way through these platforms. We are using our strength, which is the human resource, in a very efficient way through this platform. So our strength is human resource, skilled human resource. We are using that through platforms in an efficient way, and that is the reason this market caps are going on. So I never compare US big tech with Indian platforms. I believe Indian platforms are much, much superior, much bigger, and so will do phenomenally well in next 5-10 years. That is a bold call which we have taken.
And it is an interesting, bold call, which we will delve a little deeper into on another day. Thanks so much for joining us today. Absolute pleasure speaking with you, Sandip, as always.
Thank you.
All right, let's take this forward. Let's talk about a few of these stocks.